In the last video, we made one important distinction. A sell-off in the hottest trade is not automatically a market crash. If AI stocks, chip stocks, or mega-cap tech are getting hit, that can feel like the whole market is breaking because those names dominate the headlines. But sometimes the market is not crashing. Sometimes leadership is rotating. Money leaves the crowded winners and moves into safer, cheaper, or less crowded areas. That is normal. But here's the follow-up question every beginner needs to ask. When does rotation become a real breakdown? Because that is where investors get hurt. Some people panic too early and sell every red day. Other people stay calm too long and ignore the evidence when the damage is spreading. Market survival is not about guessing the perfect answer immediately. It is about knowing what evidence would change your read. So in this video, we are going to walk through 5 warning signs that a normal leadership rotation may be turning into something more dangerous. Warning sign number 1. Weakness spreads beyond the original problem area. If the first problem is AI and semiconductors, then the first question is simple. Is the damage staying there? A contained sell-off means the crowded group is under pressure, but the rest of the market is still functioning. Maybe healthcare holds up. Maybe staples hold up. Maybe financials hold up. Maybe equal weight stocks are stronger than the headline index. That tells you investors are still rotating inside the market. They are not abandoning risk completely. But if weakness spreads from the leaders into almost everything, the message changes. If tech is falling, small caps are falling, equal weight stocks are falling, cyclicals are falling, defensives stop helping, and even the safer areas start breaking, then you are no longer looking at simple rotation. You are looking at broad risk-off behavior. That is when the question changes from which sector is weak to is the market losing buyers. Warning sign number 2. Defensive sectors stop defending. Beginners often ignore defensive sectors because they are boring. But boring sectors tell you a lot during stress. When staples, utilities, healthcare, and other defensive areas hold up, it usually means money is still looking for shelter inside equities. That can be rotation. But if the defensive areas start failing too, that is different. It means investors may not be rotating from risky stocks into safer stocks. They may be reducing equity exposure altogether. Think of it like a storm. If people move from the beach to the hotel lobby, they are still staying at the resort. If people leave the resort completely, the situation is more serious. Defensives are the hotel lobby. When they stop working, the storm may be getting worse. Warning sign number 3, failed bounces. This one is important because beginners love the first green candle after a sell-off. A stock drops hard, then bounces for a day and people immediately say, the bottom is in. Maybe, but a bounce is not the same thing as repair. After a real sell-off, the market usually tries to bounce. The question is, what happens after the bounce? Does price reclaim important areas? Do buyers show up with conviction? Does leadership improve? Does breadth get better? Or does the bounce fade quickly and sellers take control again? A failed bounce tells you supply is still there. It tells you people are using strength to sell. One failed bounce is not always fatal, but repeated failed bounces are a warning. That is how markets roll over. Not always in one straight line. Often they drop, bounce, fail, drop again, bounce again, fail again, and slowly train investors to buy dips right before the dips stop working. That is why the survival rule is this. Do not trust a bounce until it proves itself. Green does not automatically mean repaired. Warning sign number 4. Volatility rises while breadth gets worse. Volatility by itself is not enough. Markets can have normal volatility. A little fear can even be healthy after a strong run. The problem is when volatility rises at the same time, participation deteriorates. That means fewer stocks are holding the market up, while fear is increasing. The headline index may still look okay because a few large names are supporting it. But underneath the surface, more stocks are breaking. This is why breadth matters. Breadth asks whether strength is broad or narrow. If only a few leaders are holding the index together, the market is more fragile. If those leaders then start breaking too, The index can fall fast because there's not much support underneath. So the warning is not just volatility is up. The warning is volatility is up and fewer stocks are participating. That combination deserves respect. Warning sign number 5. The story changes from price damage to behavior damage. Price damage is when stocks fall. Behavior damage is when investors start acting differently. You see forced selling. You see dip buyers stop showing up. You see good news get sold. You see bad news get punished harder. You see support levels fail and fail again. You see crowded trades stop recovering. You see people who are confident suddenly start looking for exits. That is when the psychology shifts. The market is not just pulling back anymore. The market is teaching people that risk is not free. And once psychology changes, the same news can produce a different reaction. A stock that used to rally on okay news may start falling on okay news. A sector that used to recover every dip may start failing every bounce. That is behavior damage. So how should a beginner use this? Do not turn these warning signs into panic buttons. Use them as a checklist. If only one warning sign appears, slow down. If 2 or 3 appear together, reduce confidence. If most of them appear at the same time, stop treating the sell-off like harmless noise. Here's the simple checklist. Number 1, is weakness spreading beyond the original hot trade? Number 2, are defensive sectors still working? Number 3, are bounces reclaiming ground or failing quickly? Number 4, is volatility rising while breadth gets worse? Number 5, has investor behavior changed from buying dips to selling strength? That checklist is more useful than the emotional question beginners ask, which is, should I be scared? Fear is not a strategy. The goal is not to predict every market turn perfectly. The goal is to avoid the 2 beginner mistakes. Mistake 1, panic selling every leadership correction. Mistake 2, ignoring a real breakdown because you want the old bull market back. The survival rule is simple. Rotation is normal when money moves from one group to another. Breakdown risk rises when money stops finding shelter and weakness spreads across the market. Do not guess. Watch the spread of weakness. Watch the bounces. Watch defensives. Watch breadth. Watch behavior. That is how you stop reacting to headlines and start reading the market like a survivor. This is Market Survival School. No hype, no guru fantasy, just market survival.